All right, let's unpack this. Today, we're diving deep into the complex forces shaping the global economy. We're looking at policy shifts, market signals, all of it. You've sent us some really intriguing sources, and our mission today is basically to distill the critical nuggets about the U.S. financial scene, inflation, and, yeah, those warning signs we keep hearing about.
Absolutely. And what's fascinating, I think, is seeing how these pieces, individually quite powerful, really connect. They form a larger picture of the economic pressures right now, and importantly, the responses to them will help you understand not just what is happening, but maybe more importantly, why it matters.
Great. So first up, let's look at two sources that really hit on this interplay between central bank policy and, well, politics. We've got inflation in the Fed and last chance. Now, inflation in the Fed points to the July inflation report. The expectation is, what, a 0.2% uptick, so 2.6% annually.
Right. And that's probably not enough to get the Fed cutting rates. I mean, the chance of a September cut is only around 59%. It's not a sure thing at all.
And this is where last chance comes in, showing the intense political pressure on Chairman Powell. There's talk of bullying from the White House if rates aren't lowered.
Yeah, even this for cause argument floating around for his resignation.
Tied to the Fed headquarters renovations being over budget by, what, $2.5 billion? Seems a bit specific.
It does. The underlying push seems to be for a 1% official rate somehow. But using the renovations, well, it raises eyebrows. And the danger here, if they actually forced a resignation, is pretty significant. You could see a bond market sell-off, potentially pushing that long end past 5%.
And weaken the dollar further, too.
Exactly. Plus, this whole idea that just slashing the official rate will magically bring down the whole yield curve and fix the budget, it's flawed.
We've seen that before, right?
Yeah, look at Japan or Germany or the UK. It rarely works out quite like that. The impact isn't always as broad as policymakers hope.
Okay. Building on central bank actions, our next source, Paving the Way, gives us a really interesting comparison. It contrasts the Fed's balance sheet reduction, which has been, let's say, less aggressive and no rate cuts yet with the ECB.
Right, the European Central Bank.
Yeah.
They've been much more aggressive. They've slashed their balance sheet by nearly 50% since 2022.
50%. And they've already cut rates. They seem really focused on normalizing their finances.
Meanwhile, back in the U.S., you've got clear stress showing up in the real estate sector. But Powell's interpretation of the Fed's mandate seems quite narrow, right? Focused strictly on employment and inflation.
Yeah, it contrasts sharply with the ECB, which seems to be taking a broader view, maybe because their economy is more fragile. GDP growth is pretty anemic over there.
Well, bottom line, both central banks are definitely facing stagflation. And they're both draining liquidity, which is key.
And that could hit the overnight markets, equity markets too.
Potentially, yes. It could even be the trigger for the next round of balance sheet expansion, ironically. It's interesting. You see gold and Bitcoin are already kind of reacting, maybe telling us what's coming down the pike.
Interesting point. Okay, let's pivot now to debt trap. This source really highlights a monumental challenge for the U.S. economy. The focus is shifting squarely onto the U.S. deficit and that staggering debt figure. It's already over $37 trillion.
37 trillion. It's hard to even grasp.
And the apparent bet is that AI, artificial intelligence, will somehow solve this.
That seems to be the hope, yeah. But there's a huge catch. AI needs enormous amounts of energy.
Which means the U.S. basically needs to double its energy generation capacity and upgrade the whole electrical grid just to keep up with China.
Exactly. So you get this vicious cycle. You need these huge investments to enable AI, but the government share of that investment has to be financed by, well, more debt.
So to solve the debt problem, the U.S. needs to take on more debt first.
That's the paradox right there. It really makes you ask, how do you actually break that cycle?
Well, speaking of funding all that debt, this next source, Genius, reveals a really unexpected new player. It's about the Genius Act. That's the Guiding and Establishing National Innovation for U.S. Stablecoins Act, a new law regulating stablecoins.
Stablecoins, how do they fit in?
Well, apparently stablecoin issuers are buying up treasury bills like there's no tomorrow. They've invested something like $40 billion just in 2024.
Wow.
Yeah, and they hit $200 billion in total T-bill holdings by June. That makes them, get this, a top 10 holder of US Treasury securities.
A top 10 holder. That's actually huge. So the relevance here is
The Treasury needs buyers, right?
Ah,
Especially a buyer of last resort for all this debt it needs to issue.
yeah.
So with a proper regulatory framework like the Genius Act aims to provide, stablecoins could actually become, as the source puts it, the perfect ally.
A best financing buddy for the Treasury. That's quite a thought. Definitely a potential game changer if it plays out.
Okay, let's shift focus again, this time to the dollar itself with dollar pressure. Apparently, something fundamental shifted after what the source calls Liberation Day in April.
What happened then?
Well, despite the interest rate difference between the US and Europe actually growing in the US's favor, the dollar started weakening.
Huh. That's counterintuitive. Why?
The source links it to maybe a more nationalistic US approach, definitely the higher debts, and just aggressive policy generally. And get this. Since July 3rd, U.S. debt jumped by $480 billion.
$480 billion in just a few weeks.
Yep. And ironically, that happened despite a July surplus in the budget, thanks to tariff revenue.
That just sounds unsustainable. Which, again, helps explain maybe why Bitcoin and gold are trading higher. People looking for alternatives.
Possibly. And it also makes it seem more likely that official U.S. rates will eventually have to come down just to make servicing all that debt cheaper.
Which brings up a bigger question, though.
Yeah.
What happens when trust in the U.S. economy, starts to erode on the global stage? What are the consequences?
That's the multi-trillion-dollar question, isn't it? All right, finally, let's look at more warning signs. This gives us a broader, maybe more sobering view of market health. So, yeah, equity indices are hitting new highs. We see the headlines. But there are clear red flags underneath the surface.
Like what?
Well, the highs are really concentrated in just a few huge stocks. Semiconductors, for instance, now make up something like 12% of the entire U.S. market cap.
Wow, 12%. That's a lot of eggs in one basket.
Tell me about it. Plus, corporate insiders. They've apparently been selling pretty consistently for at least 6 months now. That's often seen as a lack of confidence. But
Weirdly, yes. It's not a bullish signal, typically. What else?
worsening liquidity in the Treasury market. The bid-ask spread, a measure of that liquidity, is now above the peaks seen during the global financial crisis and even the COVID crash.
Above GFC and COVID levels. That's concerning.
Especially what?
Exactly, especially when the U.S. needs to issue at least $2 trillion more debt soon and roll over about $9 trillion that's maturing. So putting that all together, the concentration, the insider selling, the Treasury market stress, the massive financing needs, it really makes you wonder, what on earth is it going to take to actually stop this market train?
So wrapping this up, what does it all mean? We've definitely painted a complex picture today. The U.S. economy is grappling with, just staggering debt, inflation pressures, political interference in monetary policy.
And all while these new factors, like stablecoins, are suddenly emerging as potentially major players in the financial system.
It is a lot to take in, no doubt. But understanding these connections feels pretty crucial for navigating what's ahead.
Absolutely. And maybe this leaves us with a key thought for you, our listener. When you consider all these interconnected challenges we've discussed, the debt spiral, the central bank actions, the dollar dynamics, those market warning signs, what single piece of information for you stands out the most? What's the one key indicator you'll be watching most closely in the coming months? Something to think about.